If you're a small business owner and you need a loan from a bank but aren't sure what to expect, you'll want to hear this. I'm Sean. I've been a CPA for 14 years, and this is episode 6 of What is Accounting and How Do I Do It? Today, I'm going to walk you through how a bank thinks about your lending relationship, the common terminology loan officers use, and the documents that they may request from you if you're looking for a loan. So let's say you're seeking a loan from a bank. You make a call to a local bank, get connected to some random loan officer, or maybe you got referred to a loan officer by a friend of yours. Not uncommon. The first things they're likely going to ask you for are what business are you in, and how long have you been in business, where are you located, and what are you planning to use the funds for? What they're trying to do right off the bat is determine the overall lending risk of this possible relationship that you're going to start. And so the business you're in and your geographic location are very important for determining riskiness for them. For example, if you're seeking a commercial real estate loan, so like a mortgage for a commercial property that has tenants that are in business themselves, they're going to want to know what those tenants' businesses are, because they want in what your tenancy is. So if you have full tenancy, your tenants pay on time and they're in stable businesses, very low risk. But if they're all restaurants and this is, right after the pandemic, then that's extremely risky. So they will view those different, they will view that in terms of risk for themselves, the likelihood that they're going to get paid back. Um, as you move further into the process, they're going to start requesting certain documents. So the first things they're going to request are financial statements. Usually they just request at this point internally prepared financial statements. They're not going to, unless you're a huge business, force you to go out and hire a CPA to do an audit. So they're just going to ask you for something internally prepared. The more recent, the better. They will probably ask for either the most recently completed quarter or the most recently completed fiscal year. Um, they will also ask for a recent bank statement, a tax return for your business, the most recent available, and they might request a personal tax return from you. So all they're trying to do with all this is they're trying to verify the financial information that's in your financial statements. And they're also early on trying to find out what's your liquidity, how much cash do you have? And if you have to provide a personal guarantee, how much personal income do you have? And so based on that, like I said, personal guarantee, they might um, ask you or require you to provide a personal guarantee, which means they can seize, if you don't pay, it doesn't stop at the business. It's not like you can just declare bankruptcy and you're free and clear. They can come after your personal assets um, with a personal guarantee, and that's not uncommon. So don't freak out if they ask you to do that. I would try to avoid it if you can. But if they do require that, it's um, don't think it's unusual. So what are they looking for with these documents? Ultimately, the goal is to determine the likelihood that you're not going to pay them back. So what they're doing with all this stuff is they're computing how much collateral do you have, how much cash flow do you have to pay the loan back, and what have you. Um, so while they're doing all this, they're also going to check your credit history. Now, your business has a credit score just like you do personally. It's not a FICO score, it's computed in a different way, but very similar. So they're going to run a credit check for your business and you. So, obviously they want to check your past history because your past history for repaying loans is usually a very good indicator of what you intend to do in the future. So that's what they're looking for there. Um, So there's a few metrics that they're going to compute based on all this financial information that you give them. So they're going to use your financial statements or your tax return or both to compute EBITDA. And that's an acronym that stands for earnings before interest, taxes, depreciation, and amortization. I will explain how to compute that in a later video. But essentially, what that is a shortcut method to get to your operating cash flow. So, how much cash they expect you will have available to service the debt, to pay the interest and repay the principal. Um, so what they do with that? So it's not just like they take EBITDA as one number. They want to because it's not that meaningful by itself, depending on the size of your loan. They want to compute what's called a debt service coverage ratio, and that is computed as your EBITDA. So let's say you had $100,000 um, in EBITDA for a period of time, and that was average and sustainable. They're going to take that and they're going to divide it by whatever your debt service requirement is. So that's where the debt service coverage ratio comes from. And so if you had $100,000 in EBITDA and your debt service requirement for that same length of period was 50,000, you do 100,000 divided by 50,000, you get 200%, but it's usually expressed as a decimal, so it's 2x. What they're looking for there, generally anything above 1.2 is satisfactory. Depending on your overall riskiness, the business you're in, the geography, the volatility of your cash flow, they may require it to be higher than that. But that's a good 1.2 is a pretty good benchmark. They're also going to look, so that's the cash flow component. They're also going to look, like I said, at your business assets. And so a small business loan is typically collateralized by general business assets. So most people are familiar with a mortgage where it's just you're using the loan to buy a house or a building. So naturally they collateralize the loan with that piece of property. With a business loan where you're using the cash from the loan to pay for whatever it may be. Usually it's like you're trying to grow, so you're spending the money on your business to grow and investing in your business. So they're going to collateralize that with whatever you've got. They're going to use cash, any receivables you have from your customers, and other property and equipment. So if you do have buildings or land, cars, trucks that don't already have loans on them, they're going to use whatever they can take. They will discount these assets when they're computing your collateral. So don't just look at your balance sheet and be like, oh, I have $200,000 of accounts receivable, so that should be enough. They're going to discount it because if you think about what's going to happen here, like if you stop paying because your business is suffering and you don't have the cash flow, the likelihood that they're going to be able to collect all 100% of your accounts receivable is very low. So they're going to discount even in accounts receivable are a pretty liquid asset. Usually they're pretty short term in nature, and from your customers that presumably, you were comfortable with giving them, this short term credit to. So even those are going to get discounted by the bank in determining how much they think they would be able to collect on this if you stop paying them. So they're going to run through all this, do all this math. If you get approved, the paperwork doesn't end there. They're going to ask you to provide regular updates, typically on an annual basis. They may request audited financial statements on a go-forward basis, which can be very expensive. So that's something to think about if they do ask you for that. But one thing I did want to touch on before we end here is that with regard to the collateral, so there's two metrics, like I said, debt service coverage, and another metric called loan to value. LTV is often how it's referred to. If you have a home mortgage, you've likely heard this before. But that is another ratio that they're going to compute on a regular basis to make sure that you have that you sustain this level of collateral. So they can't force you to offer more collateral later, but they're going to do this for themselves. Ultimately, their goal is to assign a risk rating to your relationship. So loan to value, that just means total loan balance divided by the value of the discounted value of your collateral. And like a mortgage, with a mortgage, they like to see 80%. So they like this 20% cushion, um, so that if they do have to foreclose, they can afford to not sell it at the best market price. So they're going to do the same thing with your business assets. They're going to look for something like that, 70, 80%, and they're going to risk rate it based on those two. They're going to risk rate it. They're going to update that risk rating every year, but the initial risk rating you get when you first when your loan is first approved, that's what determines your interest rate, and they will only allow you, depending on your level of risk and the business you're in, to get a loan of a certain amount, a certain dollar amount, of course, and also the term. They may do a lower term, a lesser term than they would for other less risky businesses. So you look at your home mortgage, and 30-year fixed rate mortgage is not uncommon, but with a business, especially a small business loan, 3 to 5 years, even less than that, is very common. It's very uncommon to see something more than that. So these large, huge corporations, they're gonna have longer term loans, but at the same time, that's not necessarily a bad thing, because if your business is growing and you're doing well, and you're maybe early stages, you don't want to lock yourself into this super long term arrangement, because in 3 to 5 years, when your loan matures, if you pay it back on time, you never miss a payment, you can get better terms the second time around. So it's not necessarily a bad thing. You can get a lower rate potentially, and there are other rate options too. It's not just all fixed. You can do variable rate, and if you've been following, the Federal Open Market Committee lately, they didn't cut rates this past month, but there are future rate cuts coming. So if you're looking for a loan now, that's something to pay attention to, because that's how they base their rates off of. They use these market rates set by the Federal Reserve Bank, and that's how that works. So I hope this was helpful to you. I do want to say that I am starting a company called Ledger Ready, and my first product is a online course for small business owners where I teach accounting, bookkeeping, regular business, typical just general business finance in plain English, developed especially for small businesses. So it's not going to have any of that, all that CPA accounting jargon. And in this course, I'm going to walk you through how to set up your books, how to do this accounting on a regular basis, so that you feel empowered and confident, and get it done on your own without having to pay CPAs all kinds of money. So if you're interested in that and you want to get weekly updates on that product development, check me out at ledgerready.work. I got the link in the comments for this video, and I'll see you next time.